Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action because we are still looking at gains here with all three of the major averages trading higher as we start a new trading week. In the final hour with the Dow up just about 300 points. You're looking at the S&P up about 0.9%. And then you're looking at the Nasdaq Composite once again leading today up just over 1%. Taking a look at some of the sector action here. We are in a bit of a holding pattern ahead of tomorrow's CPI report, of course, coming off of some of the commentary that we've gotten from Fed officials last week saying that it sounds like rates are going to be headed even higher here to try and get inflation under control. Take a look at the sector action though. Right now, 11 of the S&P sectors are holding on to gains. Energy just flipping into positive territory here as I've been talking. Technology though leading the way. Communication services not too far behind. You're looking at consumer discretionary up just about 1%. Inside the Dow, some of the biggest gainers that we're seeing today are a lot of those larger cap tech names. You're looking at Microsoft's up just about 3%. Apple's up about 1% today. And then we also have a slew of earnings that are going to be coming out over the next couple of trading days. Coca-Cola is one of those names. We're looking at gains here to start off the week, up just about 1%, Dave.
It's funny you say the markets are kind of holding their breath, waiting CPI. That theoretically is true, or is all of Wall Street just at home? Because listen, I live in a town where probably 70% of my town works on Wall Street, and nobody went to work today.
I know. Or if they're at work, maybe they're not trading. Maybe we're seeing low volume here today, but we are trending in the right direction. So even though if we are in a holding pattern, it's good news today.
It's a Super Bowl market hangover. That's what I'm saying. Thank you, Shauna. China's accused the United States of flying more than 10 high-altitude balloons into its airspace over the last year, a claim the Biden administration refutes. For more on this, let's welcome in Yahoo Finance senior columnist Rick Newman. Rick, it has been a wild couple of days in this whole balloon saga, going back to Friday when something was shot down. I'm not sure we know what. What are we learning, my man?
Right. So China is obviously embarrassed by this. And what's been happening since the first one got shot down, the big one we all watched go drift across the United States and then get shot down in the Atlantic Ocean off South Carolina. So now we've got three other objects. Some sounds like a couple of those are balloons. The White House has said at least one of them is not a balloon, it's something else. And if these really are coming from China, I mean, what is happening in China? Are these already up in the air and they just can't be retrieved? How many more are coming our way? And what does China plan to do about it? So, China now is playing this tit for tat game where they said recently, oh, the United States does this too, and we've seen the U.S. Balloons coming over Chinese airspace. But there's a problem here. Number one, the White House categorically says that this is not something the United States does. And number two, where's the evidence? The U.S. here in the U.S. we've shot down 4 of these things. We've got wreckage and debris. Everybody saw the footage. Without a doubt, the Pentagon has collected all kinds of intelligence on these objects while they were still in the air. They were flying U-2 spy aircraft up to measure what these objects were doing, what kind of intelligence they might have been gathering, and what kind of equipment they might have on them. And we've got nothing like that from China. So this matters, Gabe, because President Biden is in the process, he has been for several months now, of trying to convince allies that we should all get tough on China, that China is newly militant, that it's going to be a problem in terms of territorial ambitions and other things. And this really just adds evidence. It's helping make Biden's case. And the Chinese need to do something about it, which they will. But right now, they're just backpedaling and they look kind of silly.
Yeah, Rick, I guess where does this leave the relationship between the U.S. and China? Obviously, tensions rising very quickly. And then when it comes to Biden's policy towards China, clearly there's pressure there for him to take a tougher stance against China. Do you think it's not now the time that we are finally going to see that?
No, we've already seen it, and we've talked about this a little bit. This has gone a little bit under the radar, but these export controls that Biden announced I think it was last October, with regard to selling advanced semiconductors and other types of advanced technology to China, basically a ban on that level of U.S. technology or technology expertise going to China. That includes Americans working in China on that kind of technology. That's one of the toughest, maybe the toughest kind of sanction we've ever put on China. That's way more serious than what Trump did with just with tariffs on imports, which wasn't really addressed at national security. And in addition to what Biden did with these export controls, he has been trying to convince allies with some success to do the same thing, so that we end up with what you might call kind of a coalition of nations that are refusing new technology to China. And Biden has explicitly said it's technology that could be used in missiles and weapons and other types of things like that. So this helps Biden's case, because Biden has been trying to say that President Xi Jinping in China is not just focused on peaceful economic growth so much anymore. He's been menacing toward Taiwan. He clearly is sort of starting this superpower competition with the United States. So it's ramping up. This balloon spat is going to settle down once the balloons are no longer flying around, and there will be some kind of détente here. We were able to do that with the Soviet Union during the Cold War, but clearly relations with China are just getting more tense, not less.
Then there's the TikTok issue, Rick. Senate Majority Leader Chuck Schumer says a national ban on TikTok is something that should be looked at. This comes after Senator Josh Hawley, Congressman Ken Buck introduced a bill to do so last week. We've also heard Marco Rubio talk about this, and even Democratic Senator Mark Warner hint of the concerns he has about TikTok. Is this at all realistic, do you think?
I don't think it is realistic, and I get the concerns, and it might be prudent. Like, one thing they've done which might be prudent is disallow the use of TikTok on government-issued phones, government property. But given how many people use TikTok, and it's not just that it's a lot of entertainment for people. I mean, there are livelihoods being made on TikTok now. And whatever all these politicians are so upset about, I think they need to come out and say, what is the exact problem here? I get it. The Chinese government could have access to this data. Private companies in China do not have the right, as they do here, to tell the government to get lost when the government demands data from that they may be gathering on their customers. But I think politicians need to stop being facile about this and just saying what sounds like a vaguely popular thing. Let's get tough on China, including TikTok. What exactly is their concern with people using TikTok? Is it because if I have it on my phone right now, they might be listening to this very conversation? Are they tracking people? What are they doing? Are they using TikTok information and sending it up to the balloon, which then knows where to find people and look at them? Why don't they spell this out instead of just making these sort of vague threats about an app that obviously is immensely popular and important to people who are running businesses on it?
Yeah, no question about that. And just to be clear, I have spoken to Mark Warner about that. And he didn't have any direct concerns as of what's happening now, but what they could do with that data when they want to turn something on, turn something off, the national implications for what could lie ahead. You're right, it is difficult to conceptualize that if you don't have evidence, but he laid out a pretty good case. Rick Newman, thank you. Good stuff, man.
Hi, guys.
All right, here we are in the final hour of trading. You're looking at gains across the board. This movement coming ahead of tomorrow's inflation data. For more on the recent action that we've seen, we want to bring in Jack Manley, JP Morgan Asset Management Global Strategist. Jack, it's good to see you. So we're looking at gains today. As the markets have performed since the start of the year, it's been pretty strong. The Nasdaq leading the way, the S&P up just around 7.5%. From your perspective, the gains that we've seen so far, anything more than just a short covering rally?
I think that there's a lot of hope right now that the trend that we start to see emerge in inflation continues. And that's why, at least partially, maybe some folks home right now with the nurse and a hangover. But I do think, that given that we have that CPI data coming out tomorrow, it is just hope for yet another instance of evidence that inflation has turned over. And of course, the implication of that would be perhaps a change in Fed policy. And at the end of the day, rates have been the only thing that's mattered to markets for the last 13 months. So I see why it's happening. I see that the trend is very encouraging. I don't know if I necessarily believe in the legs of it short term, but long term, certainly we are closer to the end of this hiking cycle than the beginning. And that's something to be encouraging about.
And Jack, what if that number comes in hot tomorrow? What are the implications?
It depends why it comes in hot. That's going to be the big question. There are certain things that we can account for in the CPI print that may move higher and that we can just sort of brush aside. We know that energy prices may be moving higher in that print. That's not going to really move the needle too much, especially since headline figures are typically discounted. We know that shelter's been a little bit funky right now, and so reading too much into those numbers may be a little bit dangerous. The one that I do think we need to pay pay close attention to in terms of perhaps an upside surprise is what's going on with services, because that is where inflation has shifted. It's gone from supply over to demand, and if service inflation heats up a lot harder than we would have thought, that's a little bit more durable. That's a little stickier.
What do you expect to see from services tomorrow?
I think we continue to see at least a flat, maybe a little bit of a moderation. You know, the nice thing or not so nice thing about CPI is that the lion's share is driven by shelter, and so you can see modest upside or downside surprises and a lot of other factors that won't necessarily spill over into a big blowout, you know, a high print or a significantly lower print. That's kind of the nice thing, I'd say. But the wage growth story, look, is a little bit frightening. It has held up a lot longer than we would have thought. Labor force structurally smaller than it had been in the past. That's going to feed through into services. It's going to take a while for inflation to get back down to something that we're more comfortable with.
What's a while, and what's something we're more comfortable with? Are we talking about 3.5% a year from now? And does the Fed just accept a different target?
So the funny thing about the Fed targeting, I think, is that, you know, we've been talking about a 2% Fed target on inflation for almost 20 years. And if the Fed was willing to persistently allow for an undershoot of that target, there's no reason to believe that they would not allow for us to persistently overshoot that target. I mean, very rarely have we actually come right in line with that 2% figure. So tolerating something above that without the Fed explicitly acknowledging a change to the target, I think is entirely possible. When it comes to the outlook for inflation, what should we be looking for? I do think 3-4% feels a whole lot more reasonable and certainly a lot better than where we are right now. How quick that happens, I do think has to do with shelter in particular. And, you know, we've been looking at some numbers on our end. If you look at what's going on with rent, which ultimately is what feeds through into services inflation, we start to see a very real moderating in those figures. And in fact, there are some major cities, New York City included, that have actually seen outright rent deflation over the last several months. It's going to take a little while for that to feed through, but halfway through this year, we may start to see some material downward pressure on inflation just based on shelter.
Yeah, and Jack, CPI is so important here to the markets because of the implications of what it means for Fed policy. We've really seen any time a Fed official speaks, the market really typically tends to move, and a lot of times hears what it wants to hear. Is the market putting too much, are they too invested with what the Fed officials are saying, and then instead, what should they be focused on?
You know, I got to control myself a little bit right now because I get a little heated when I talk about Fed policy. It's a real challenge, and I get it because, you know, like we said earlier, rates are what matters right now for markets, and it's been the thing that matters for the last 13 months. So understanding Fed policy, look, that's critical. But when you hear some of the comments that are coming out of the Federal Reserve, like what we saw last week out of Powell, out of Waller, we have to acknowledge that all they're doing is stirring the pot. No new information gleaned from any of that commentary. You know, we hear that, oh, well, maybe rates have to move higher from where they are right now. I could have told you that. The dot plot has looked like that since December. You know, oh, well, maybe rates are going to be higher and longer than what some people expect. Well, you know what? I bet we could poll a group of individuals and find at least one that thinks that rates are going to get cut by the end of this year, you know? So, like, not a lot of clarity, no new information. What I'd rather pay attention to is the underlying macro data, like the employment report, which is actually a lot more complex than the number that we saw, like tomorrow's inflation print and what that may mean. That, I think, is going to help to steer a much clearer view on Fed policy. I would not hang off of every word out of every Fed governor. I think you'd go crazy.
Yeah. We are going crazy. We've already started going crazy.
This is the guy who says, I get heated when I talk about the Fed, said Jack Manley. Good to see you, sir. Thanks for being in studio.
Thank you.
All right, we're just getting started here on Yahoo Finance Live. Still coming up, new data revealing just how many advertisers are fleeing Elon Musk's Twitter. We'll have that for you. Then Ford announcing it's investing billions to build a battery plant in the U.S. We'll have the details. And Airbnb shares are popping ahead of earnings. Find out what you can expect when the company reports tomorrow. Don't go away. All right, shares of Tesla down just over 1% today, but still up 80+% so far this year. CEO Elon Musk was at the Super Bowl Sunday sitting next to News Corp chairman and CEO Rupert Murdoch. Mr. Musk has proclaimed to be fiercely independent politically, despite urging his followers to vote Republican in the midterms. The photo only adds fuel to this fire. He also sat with President Trump's son-in-law Jared Kushner at the World Cup, along with the Qatari royal family. Politics may be part of the equation impacting Elon's attempted turnaround of Twitter, Shauna.
More than half of Twitter's top 1,000 advertisers in September were no longer spending on the platform during the first couple weeks of January. This is according to digital marketing firm Pathmatics. Now, CNN reporting that 625 of those 1,000 advertisers, this includes brands like Coca-Cola, Unilever, Jeep, and Wells Fargo, had yet to return. Talk about the impact that this is having on Twitter, just putting it just plainly in these numbers. This was a business that once, Dave, was a $4.5 billion advertising business for Twitter. Last month's numbers in January from Pathmatics are saying it dropped all the way to 48 million, 127 million down to 48 million when we account the top 1,000 advertisers. A dramatic drop. We know Elon Musk is trying to diversify his revenue stream, trying to go outside the ad business. It looks, at least up until this point, that has not been working, and he's under a tremendous amount of pressure to find a solution and to find it fast.
Yeah, what's the real signature win for Elon's tenure at Twitter? And largely, I gotta say, it's cutting headcount, gutting that place. But in terms of improving the platform or improving their bloodline, which is advertising, he has come up radically short, and it's not entirely clear what is going to save advertising on this platform. If the Super Bowl didn't do it, and we haven't had any new numbers out from Twitter, hopefully we'll get some today or tomorrow, then they could be in deep, deep trouble. And that could, and just saying could, include bankruptcy at some point. What is the road to profitability for Elon at Twitter? And I circle back to that political point where we started. Look, if you want to be available to all advertisers, you want to stay out of the political fray, you don't want them to view you through a political spectrum. Same thing with Tesla, right? You don't want people buying a Tesla thinking about, do I like Rupert Murdoch, a brilliant businessman, but certainly one of the more divisive CEOs, chairman in this country. It's interesting to see him covet mainstream advertisers and sit with Rupert. I'm just saying.
Yeah, it doesn't seem like a strategy that's going to pay off or make sense, at least in this point, given the complication, given the challenges that he faces at Twitter right now, the fact that so many of the larger brands no longer want to advertise on that platform. Now, the company has started to offer some incentives. They are doing some things to try and get those advertisers back. They are offering some free ads, lifting that ban on political advertising, also allowing companies greater control over the positioning of their ads. They also hired a third-party company that will give the brands a little bit more information just in terms of where they're advertising next to and with what type of information, which you think will be a step in the right direction. But taking a look at these numbers from Pathmatics, it hasn't really done much because that number has steadily declined over the last several months. And it's clear he's going to need to do more, maybe not sitting alongside Rupert Murdoch at the Super Bowl, to do something more to win back some of those brands that now are just way too hesitant.
Right, and politics isn't how he wins them back. It's competing with the likes of TikTok. That is, of course, what's going to get those advertisers back, showing that you can offer a similar type of product or something close to TikTok, or even what you're seeing on Reels. Not entirely clear if that's going to happen. Elon Musk has a heavy lift. I did use it a lot throughout the Super Bowl. It did work very well. Twitter and Super Bowl ads is perfect. That is the ultimate marriage of the platform to any event. I think it is the perfect marriage to sports and social media. Better than TikTok, better than Instagram, but we'd love to see some numbers.
Yeah, I was going to say, that's why these numbers, the numbers from the Super Bowl, are going to be so critical here, just really getting a read of the room of where Twitter stands today. All right, well, coming up next, the January CPI report coming out tomorrow, and to find out if any surprises could be in store when we come back.
What's up, everybody? We've got some major econ data and big-time earnings on deck for the week ahead. Here's what you need to know. The econ data out this week. First, the big one everybody's watching, that's CPI. Of course, that's going to give us the latest inflation reading for the month of January. Now, we're going to get the headline number. That's Tuesday morning. It's going to have a major impact on the Federal Reserve's interest rate policy moving forward. Next up, you've got retail sales. That data being released on Wednesday. That's expected to give us a better picture of the state of the U.S. consumer and the health of the U.S. economy. We've had 2 consecutive months of retail sales declines, so we'll see if that trend continues. And the earnings train chugs along with some of the country's most talked about companies reporting earnings and revenue. So we've got Coca-Cola, we've got Airbnb, Roblox, Dunkin', Roku, Shopify, Cisco, and more. All of them are set to reveal how they performed in the last quarter. We're going to have those stories and everything else that you need to know this week at Yahoo Finance.
Well, ahead of that economic data and the earnings reports later this week, MasterCard releasing its January spending pulse report, and the consumer once again proving to be pretty resilient. U.S. retail sales last month, ex-autos jumping 8.8% from a year ago. And it's important to note that those numbers do not account for inflation. For more on this, we want to bring in Michelle Meyer, MasterCard Economics Institute Chief U.S. Economist. Michelle, it's great to see you again. So that headline number, 8.8% jump. Restaurant spending jumped about 24%. When you're taking into account the consumer right now looks pretty stable from our view, what are you seeing and what's driving that spending?
Well, you're absolutely right. I mean, it is an impressive increase in spending, particularly for some categories like restaurants, like you mentioned, or broadly experience-based spending. So there's some differences in terms of how consumers are spending, some choices that they're undertaking in terms of their basket of spend, but they are still out there spending. And the question is why and how? And a lot of that speaks to the health of the labor market. If you look at the last jobs report, over 500,000 jobs created. Wage growth is continuing, and aggregate wages are clearly still picking up, and that's supporting overall spend. So a lot of that is the consumer purchasing power that reflects the health of the labor market.
Do you expect anything in that story to change when we get retail sales on Wednesday? What do you think we'll learn?
Well, I think it's going to be, a strong report on Wednesday. We know that the last 2 months had, from the census data, contraction on a month-over-month basis. But we also know that the Census Bureau data around this time of year tends to be very volatile, very noisy, and subject to seasonal challenges. So I think once you smooth through the last few months, it should reveal an increasing trend consistent with what we're seeing in the spending pulse data. So it's important to look past some of the month-to-month swings. We may see a very big pop this month, but that would be after the decline we had the month before from the retail sales numbers from the government. So definitely look at the trend, and the trend is still showing the consumers out there spending.
Michelle, are there any signs of stress in the data that you're looking at, or any trends that you're seeing in terms of trade-offs? Maybe people are trading down, because that's something that we're starting to hear about in this quarter's earnings reports.
Well, I think the consumer is being mindful right now, and they're certainly making choices of how they spend, what they spend on, where they spend, et cetera. And it was clear in the holiday shopping season to us that consumers were being driven by the promotional period. We had a bit of a fits and starts to the holiday season, particularly for things like apparel or department stores, where you had a rush of spending around the Black Friday period and then another rush of spending right at the end of the holiday season. And that tells us consumers, are aware there's more inventory out there. They want to see discounting and promotions. And it's a bit more of a disinflationary psychology, which I think is also being reflected in the CPI data. And we'll see more of that when you look at some of the underlying goods inflation out tomorrow.
And that spending, combined with the strength of the labor market, what does it tell you about Jerome Powell's ability to bring inflation down near his target anytime soon?
Well, I think from the Fed's point of view, there are both demand side and supply side factors that are driving inflation. And the good news is on the supply side, they're getting a good amount of support. Supply chains have been fixed to some extent. We do have a lot more inventory in the economy, better inventory management. That's all really positive when it comes to helping to contain some of the inflation, particularly for goods. Now, the challenge, though, is that, when you think about the Fed's dual mandate, it's price stability, which goes hand in hand with full employment. And the unemployment rate is very, very low. It just hit a 53-year low in the last report. So they do want to take out some of that excess in the labor market, get to a more sustainable and healthy pace of job creation, which would still allow for consumers to be out there spending, but at a rate that, again, is more consistent with a stable and sound economy.
Michelle, despite all this, despite the fact that the consumer is so resilient, the labor market has remained pretty solid here up until this point, there are still calls for a looming recession, what that might look like in the second half of the year. Are you seeing that at all in your data?
I feel like there's been looming calls for recession for the most of last year. And, it clearly has not come. Now, I think we have to be mindful when we talk about what a recession is. Some parts of the economy are under a lot of pressure. The housing market throughout last year was in contraction territory when you look at home sales. And now when you look at home prices, you are seeing some sides of the manufacturing sector start to pull back. But when you put all the pieces together and you account for this real strength, particularly in the experience part of our economy, it's still an economy that is very much expanding and able to manage through what has been some tough headwinds, particularly when it comes to higher interest rates. But ultimately, the goal is to kind of rebalance the economy after the last few years where we've had quite unprecedented swings in economic growth and volatility. So we need to right-size the economy, and that, I think, is what we're seeing throughout the course of this year.
All right, got to leave it there. Michelle Meyer from MasterCard, thanks so much. Great stuff. Coming up, Manchester United might be making a big move away from the pitch. More details after the break.
Time for a triple play. Three stocks that we're watching in the final 30 minutes of trading. We've got Twilio, Manchester United, and Microsoft. Kicking it off with Twilio, the company announcing another round of job cuts. 1,500 employees, that's 17% of its workforce. They're also restructuring its business into two units, Twilio Communications and also Twilio Data and Applications. Today's cuts coming after Twilio already laid off about 11% of its workers last fall. Now, CEO Jeff Lawson writing in a blog post that, quote, "It's clear we've gotten too big and the company now needs to, quote, prioritize profit far more than before." And Josh, just really points to a trend that we certainly have seen not only in the cloud computing space, but also what we've seen more broadly speaking in tech firms. A number of the larger tech firms have already announced layoffs either earlier this year, late last year. And I think the big question now from investors is whether or not we're going to see that continue, and we could also see more job cuts as some of the firms that have already announced.
Yeah, I was going to say that's the big thing here, right, that you pointed out, is it's round 2 of layoffs. We thought in September, okay, Twilio's starting to figure out where they're gonna cut, how they're gonna make more money from who they already have, and sort of consolidate. And now they're realizing, we actually need to cut more. We're hearing from Meta that might be happening at Meta as well. There was a report in the Financial Times that Meta might be cutting more. So I think it's curious to see, you see these first round of layoffs, but is that really enough for some of these tech companies? That's certainly something we're going to be watching, I think, moving forward. My play today, though, is Manchester United. Shares up slightly as more reports coming in speculating the European Premier League soccer club will be sold to Qatari investors. So Bloomberg reporting that the Qatar Investment Authority is leading this bid alongside local family offices. Now, this does mean that wouldn't be the same group that already owns soccer club Paris Saint-Germain. They can't do that. That would be a conflict. And so Forbes has previously valued the Glazer family-owned Manchester United as one of the most expensive brands in the world, slapping an estimated price tag of $4.6 billion on Man U. Now, all of this is ahead of the supposed February 17th deadline created by the Rain Group for bids to be submitted, Dave. So we're coming right up on that deadline. It seems like, is it going to be the whole club? Is it going to be part of the club? It doesn't seem like there's a clear picture on that, if it's going to be sold at all. If it gets sold, I know you and I will both be excited because it might be a record, and we loved waiting to see if those teams are sold for a record or not.
Will be. I think let's just say will be a record.
Sure.
I don't think there's any question when you get a brand like that out in the market, not just a club with the history, but the brand. We're going to top anything we've seen. Yeah, the early reports that they were going to sell part, but the people that are interested in this team don't typically buy part of something. They want all of it, including that group, the Saudis who may have been interested, Jim Ratcliffe, Sir Jim Ratcliffe, the richest man in the UK, and the Daily Mail reporting Elon Musk might put in a bid. And I'm sure you love that, given what he paid for Twitter.
I'm sure Tesla investors probably don't love that, right? Is he coming back to the Tesla well to buy something new again?
He needs to be saving his money at this point. We were just talking about all the challenges that he's having with Twitter up until now. He has a heck of a lot of money. But I don't know I guess you could also make the argument that sports teams, especially when you take into account what the Glazer family reportedly paid for it years ago versus what it is today, maybe it could be a good investment.
They
So I don't know.
paid less than $1 billion.
I'd rather own Man U than Twitter.
I think, yeah.
No
Elon
doubt.
Musk will probably agree with you.
Give me some Tesla investors on the line right now, though, on that report. My play is the biggest gainer in the Dow. Microsoft shares surging on a note from Morgan Stanley. Analyst Keith Weiss writing, quote, near-term cyclical impacts create an attractive entry point into one of the best secular growth stories in tech. Weiss adding he models 5 straight quarters of accelerating growth in earnings per share off that December quarter. Quote, a setup of supportive shares moving higher, and Weiss has an overweight rating. A price target of 307 implies more than a 12% upside. Microsoft, of course, the subject of all the AI buzz in recent months, certainly from this mouth, announcing several weeks ago they'd invested $10 billion in OpenAI's ChatGPT. Chat apologized to me for not being able to predict stock prices with certainties. They couldn't tell me what Microsoft was going to go up. They also said they couldn't tell me who the leader in AI is other than Google, Amazon, Facebook, Microsoft, and Apple. But you can see shares a big day today and up more than 13% this year. This just in, though, from the information that Microsoft-owned LinkedIn is joining the parade of layoffs today in their recruiting department. Again, that's just in from the information. They laid off 10,000 people, Microsoft did last year.
Yeah, certainly. We also have to think that might be indicative of the job environment right now and where we might be headed over the next couple of months here. But it's interesting when it comes to Microsoft and a lot of the excitement that we have certainly seen on the street. So Microsoft outperformed many of its tech peers last week. We're seeing that carry into this week. And Stifel also raising its price target on the stock. Lots of, encouragement, positivity about AI. But even before we start to see that come to fruition, a lot of these notes mentioning their cloud business, Azure. They see that stabilizing. They see that growth returning and getting stronger here over the next couple of years. So that, of course, could be a catalyst for Microsoft going forward.
Well, I'll throw in a third firm and a third part of the business as well that was mentioned today for Microsoft. In a note, Bank of America wrote about Okta. They highlighted that Microsoft is putting pressure on Okta in that space, in the cybersecurity, or in the software space there, in the security space. And I found that interesting. It just tells you how big this business is. Yeah. There's a lot of people talking ChatGPT. We're excited about the AI part, but obviously there's so much else already going on positively with Microsoft.
It wasn't that long ago, we were just talking about Azure, and that was really the growth story. And now,
Now it's all ChatGPT, AI, looking 10 years down the line. All right, well, coming up next, a pair of travel stocks stepping into the earnings gauntlet tomorrow. An analyst telling us what lies ahead for Airbnb and TripAdvisor when we come back.
Airbnb in the spotlight tomorrow afternoon. The vacation rental platform set to report its fourth quarter earnings tomorrow after the bell. And investors are bullish leading up to a checkout. Shares up nearly 7% on the day. Another travel stock, TripAdvisor, also preparing to release earnings tomorrow afternoon. Jed Kelly, Oppenheimer's managing director of equity research, covers them both. Good to see you, sir. Let's start with Airbnb. Why the pop and what are your expectations?
Yeah, I think the pop today is related to some strong third-party data we're seeing from Airbnb. They do a decent job tracking Airbnb activity, and I think they released their January data over the weekend, and it looks pretty strong. So I think investors that subscribe to that data, it's pointing to January nights actually accelerating. So it looks like there could actually potentially be upside to the street's earnings. I mean, Airbnb is a very highly shorted stock too, so there's probably short covering going into the print. So I think those are the two leading factors for why the stock's up today.
Jed, you also covered TripAdvisor, have a market performer rating on that stock. It's also had a strong start to the year, up about 35%. What would make you more optimistic, more bullish on this name heading into not only the report tomorrow, but the second half of the year?
Yeah, with TripAdvisor, it's all around the strategy. Their tours and activities business, Viator, continues to be on a pretty solid growth trajectory. The key is, what's the new CEO, Matt Goldberg, going to do around TripAdvisor core, and how do you make that asset more monetizable, right? They have a lot of Google competition. I know everyone's talking about some of the new search features you're seeing around AI and how that impacts travel. If Google and Bing are able to do, enhance their search around travel with AI, then that's a headwind for TripAdvisor. So I think with TripAdvisor, a lot of it's around what's the strategy. I mean, we've been covering this stock now, I think, for almost 7 years. We've never been able to recommend it, and it's all about the Google risk. So the more you use Google Maps, the more negative it is for TripAdvisor.
Boy, interesting point on the AI. Touches just about every industry we cover here. Earlier today, Expedia CEO Peter Kern joined us and had this to say about travel demand so far in 23. Listen.
So far through the beginning of the year, it's been pretty strong throughout. It's not just a January thing. And, it's global. We've seen it in many places. We've seen it driven by lots of categories. International continues to grow. And remember, we're seeing a time where last year, this time, we a lot of things weren't open yet. So things like cherry blossoms, international events, things like that are still growing, and people are getting back to that in a pretty robust way.
Gotta love the cherry blossoms. The initial read on this, Jed, was it was revenge travel, but is your data telling you this is just kind of a new norm, the commitment to travel?
Yeah, I don't know if it's necessarily a new norm. I think we've been seeing it, right? Even before COVID, experiences were growing faster than things, especially with the younger generation, Gen Z, millennials. They value experiences over things. So I think there's part of that. I think the other thing that COVID kind of has let people do is it's given people more flexibility to not have to travel on a Friday and come back on a Sunday, right? You can now leave on a Wednesday or Thursday, 2 cheaper days to fly, and come back maybe on a Monday or Tuesday. So I think that flexibility's a pop to demand. And, I wouldn't call it a revenge travel. I mean, the data is pretty strong in the U.S. and the U.S. has been pretty open for travel now for at least the last 18 months. And, we're coming up on spring break travel here in the Northeast. Rates are still high. You're trying to fly. It's still really high. So I think I think it's just people wanting to travel. And I think it's this thing that experiences are valued over products or things.
Jed, so you cover travel. You also cover DraftKings. It's certainly coming off a huge weekend, you would think, for the company. They had their Super Bowl ad. Certainly, you would think they saw a huge uptick in terms of traffic on their site. How big of a boost do you see Super Bowl being to DraftKings, and what are you expecting to hear from the company later this week?
Yeah, I think Super Bowl, it's in their guidance. I think, you look at the geo-complied data, I think traffic to sites was up over 30%, so that's strong. We're hearing that I think the Super Bowl was a net positive for the books. The Chiefs winning was a good outcome. The game did go over, but I think they all had pretty good outcomes in their prop bets, even though you did have stars with big games. So I don't know. I think the Super Bowl's in the guidance. I think the outlook's all about, are they able to be able to prove to the street that they can actually generate and grow this business profitably, right? So they've got a pretty good outlook for state launches this year. So that should allow them to leverage their advertising spend better. And I think if you can start to show that they're leveraging their advertising spend, you also have the land-based guys being more rational, which is a positive. So I think you see more rationalization in the model or in the industry. And then you actually start to see advertising leverage, and that it could be down year over year. I think that's a positive for the stock.
All right, we will see what we get later this week. DraftKings up about 3 or 8% over the last 3 months. Jed Kelly, thanks so much. Well, Meta announcing the exit of the company's longtime chief business officer today. The stock moving to the upside today, up just about 3%. A lot of that has to do with a report that we got out over the weekend from the FT saying that more cuts could be ahead for the tech giant. Let's talk more about this with the Yahoo Finance tech reporter, Ali Garfinkel. Ali, starting with the C-suite, what are we seeing and what do you think that signals for Meta?
Yeah, Shauna, there's some real musical chairs going on around here. Levine was at the company for 13 years. She was actually only chief business officer since 2021, right before Meta announced its name change. So I think the fact that she's been there, the fact that it's happened, it's still a seismic shift. She also was famously a confidant of Sheryl Sandberg's. It's important to say Sandberg left in September and has also been replaced by Javier Olivan. At the same time, we also have a new CFO coming out of Meta. We have Susan Lee, who became CFO in November. She was only 36 at the time of the appointment. So what does it all mean? This kind of shuffling around in the C-suite is a pretty big deal for a company like Meta. And I'd say that It's happening at the time when what we're talking about is Meta's year of efficiency. They've changed their messaging, they've changed how they're talking about who they are, and you have to wonder if there isn't some correlation with the shifts in the C-suite.
That is interesting. All right, Allie. So Shopify reports fourth quarter earnings after the bell on Wednesday. 3 key things you're watching for.
Yeah, I think it's important to say off the cuff, Dave, Shopify is kind of hard to make tangible. But I want to say off the cuff that Shopify's business is heavily tied up in areas that we think of as niche, but actually are pretty ubiquitous. So one of those first areas is checkout. Checkout competition is going to get more substantial. Now, what does this actually mean? It means shopper conversion. How do you make it as easy as possible for shoppers to become buyers? And Amazon has actually taken a shot at Shopify. They launched something called Buy with Prime, where if you, Dave Briggs, had a CBD drink Shopify store, you could actually have a Buy with Prime feature on that. I actually think that we're going to hear, what I've heard across the board is that we are going to absolutely hear analysts ask about Buy with Prime if they don't bring it up first. So that's number one, checkout. Seems niche, but is everywhere. Next, new website creation. Now, when you think of website creation, like I've been looking at maybe making a website, and what I've heard is WordPress, GoDaddy, Wix, Squarespace, those are the ones. But Shopify is starting to eat their lunch, particularly in the case of WordPress. You have, for instance, in the last year over year, you have Shopify's share of visits increased to 15% from about 7.5% from GoDaddy, Squarespace, Wix. So new website creation could be an important area for them. Now, the last thing is something that is not hard to make tangible, profitability and price hikes. So Shopify actually last month announced a pretty substantial price update. Yeah. It's basic, for instance, increased from $29 per month to $29 per month from $14 per month. That's a 107% increase. And this is actually expected to improve profitability. Analysts believe there's a real opportunity for Shopify to cash in. The bottom line here is they have a really eclectic world of competitors that only seems to be getting bigger.
They hadn't raised their prices in a long time, but that's a huge increase. They better think that product is really sticky compared to Amazon Buy with Prime, right?
They believe. I don't know if I'm ready to pay for that, to be honest,
right.
But hey, 14 to 29 for some people, I imagine that's worth it.
Really shocking.
Yeah. Sticker shock.
Great, thank you. Appreciate that. Ahead, Super Bowl Sunday has been an official holiday of sorts for over 50 years, but should the big game be moving to another day of the week? Find out next. Are you feeling a bit Super Bowl sluggish today? Aren't we all? Is your office emptier than usual? No surprise, Super Bowl Monday is among the least productive work days on the calendar. We're all fat and tired. The estimated lost productivity for absent and distracted workers today is $6.5 billion, according to outplacement firm Challenger Gray and Christmas. 42% of Americans in a recent Harris poll said the day after the Super Bowl should be a national holiday, while more than 26 million Americans said they were likely to miss at least some work today, including a record-breaking 18.8 million not planning to go to work at all, according to the Workforce Institute. There is, however, a better way. It's Super Bowl Saturday, and a Change.org petition asking to move the Super Bowl back one night currently has over 145,000 signatures, one being mine. This loss of productivity is avoidable, people. Why must we suffer? Why must we drag our kids out of bed and deliver them to school late? The ratings would still exceed 100 million people easy. The parties would be so much better, and we'd all be better for Super Bowl Saturday, and your employer would have productive employees. Are you with me? Well, we asked you in this Yahoo Finance poll. 51.7% of you say the Super Bowl should be moved to Saturday. A little more than a quarter of you say just make Monday a holiday. 22% say nothing needs to change, but all told, 78% of you say something here needs to change, Shauna.
Yeah.
What needs to change?
You know,
is the
for
question.
me, I would love it if it were to be moved on Saturday. If the NFL is resisting that, I get
Which
it.
they are.
Because I think, yeah, they have been. Goodell has said it a couple of times back in 2018. He said that it makes more sense for them to be on Sunday. At least just move it a few hours earlier. You get rid of some of the issues that you were talking about. The big question, though, is what that would do for ratings, especially on the West Coast, given the time change. I think that's a key question to ask there. But when you take into account some states are going forward and making some changes or wanting to implement some changes, there's lawmakers in Tennessee, they've introduced a bill to make it an official state holiday on Monday. No traction yet, though, but we can't get them out. Philadelphia, my hometown, this was a little ambitious, probably gave them bad luck, but some schools in Philadelphia delayed the opening this morning 2 hours because of what you were saying. Parents were
they
dreading.
thought they were going to win.
They thought they were going to win, and they wanted to let everyone celebrate. So, I don't know.
I have 3 kids,
Yeah.
17, 15, and 11. All 3 of them were over an hour late because they couldn't function this morning.
Yeah.
Something needs to change.
Move it earlier.
Super Bowl Saturday.
Move it. Yeah, Super
Let's
Bowl
go.
Saturday. At
Let's
least just
do
move
this.
it an hour or two earlier. I'll settle for that. All right, well, coming up next, we are counting down to the closing bell on Wall Street. Dow up 348.
All right, just a couple of minutes away from the closing bell, so let's bring in Yahoo Finance's Jared Blickery to break down the market action. What do we got?
Well, let's recap an earnings announcement from earlier this morning. This is Monday.com. You can see it's up 10% today. Looking at a max chart from its IPO, you can see pretty depressed still. Now, it did smash sales expectation for the full year. The office software application company also managed an adjusted earnings per share print of 44 cents when the street was looking for a similar number with a negative sign or a loss of 40 cents. Vital Knowledge liked the surprise, saying the report shows huge EPS upside, while they also liked the bullish 2023 outlook. Now, Citi, which rates us Monday in overweight with a 156 price target, liked the outlook too, cautioning that, quote, a more limited billings upside could be a focus. Now, we got to get to Sorrento Therapeutics. This stock not doing well, and especially today. This is another chapter closing on this biotech stock, at least for now, as Sorrento Therapeutics filed for Chapter 11 bankruptcy protection early this morning. The once COVID darling and pandemic high flyer coming crashing back down to earth. Stock selling for only pennies today amid an eye-watering 70% one-day decline. So Sorrento is no stranger to controversy, as the CEO hyped its COVID, quote, cure in mid-2020, only to be met with a barrage of short seller reports. With just a few seconds here, let's check in on crypto stocks, also having kind of a nasty day. Got some scary reports about Paxos potentially being sued if they were to issue any more Binance tokens. So let's take a look at the crypto space, again, negative as we head into that final bell. Here it is.
And there we go, starting the new trading week with gains. All three of the major averages ending to the upside here. Nasdaq, the leader, up just about 1.5%. The Dow adding 377 points as many on the street look ahead to tomorrow morning's CPI report. All right, let's talk about some of the big movers of the day. First up, Chevron. At least it was a big story here because closing not too far from the flat line, off just about 0.5%. But the Wall Street Journal reported that the oil giant might extend its CEO, Mike Wirth, past the mandatory retirement age. As of right now, Wirth would hit Chevron's mandatory retirement age in late 2025. Why we're talking about this is a man who has been there for about 5 years. And within that time, Chevron has performed very well, Dave. So it's no surprise there that Chevron doesn't want to see him walk out the door anytime soon.
Yeah, why would they? Yeah. First off, it appears that they don't have any great in-house candidates. That's what the reporting would suggest. But returns going back to 2018 when Wirth took over, 70% returns. The man is delivering $75 billion share buyback, more recently criticized, of course, by the White House. Other companies have gone along with this theme most recently. Caterpillar, Target, Boeing have all done away with that mandatory retirement age. And it goes along with what we're seeing in greater society here, at least in this country. He's 65. That is no longer old by any stretch of the imagination. Anybody notice the President of the United States happens to be 80 and he's running again at 82 in 2024? He's not alone. Roger Penske, one of the most successful CEOs on the planet, 84 years old. How about Bob Iger? He's 7 years older than Wirth is at 72 years old. It seems like we need to get on board, Shauna. Largely speaking, 65 is just no longer what it used to be. People are working well through their 80s nowadays. I think we're going to see more and more Fortune 500 companies do away with those mandatory retirement ages altogether.
Yeah, like you said, we're already starting to see that trend, and also just taking a step back and talking about the current economic environment right now, and potentially in a time when Wirth would have to step aside. Now, his tenure is not up till 2025, or he wouldn't reach 65 until 2025. But right now, we're in the higher interest rate environment. We have the war in Ukraine, the looming recession, a number of headwinds here, challenges facing companies. So I think that makes a lot of sense why a number of companies are holding on to their CEOs if they've performed well up until this point.
I left out the Oracle. Warren's what? Yep. Warren's older than 90 isn't he? 91? Yeah. He's still going pretty strong, so that's a little more evidence. I also want to take a look at Zillow today, closing in the green after a bullish note from Evercore ISI. Highlights the first quarter of this year will be trough quarter for housing data, and there are tentative signs of a rapid recovery. Now, key to this note, they do still suggest that Q1 could still have a rough patch ahead, that again, to remind you, could be in their eyes the trough, and the positive, the turnaround happens in Q2 2023. So there is still a little bit of a gray area between those who feel that the worst is totally, entirely behind us, and Evercore who still sees some rough road ahead. It does look like the housing sector is survived a lot better than many feared.
Yeah, it has survived a lot better than many feared, and also seems to be maybe turning a quarter more quickly than maybe some had anticipated, as if we go back several months ago in terms of the predictions that we were getting out from the street. This is similar to what we heard from Redfin CEO Glenn Kelman, who was on with us not too long ago, and he pointed to the fact that he thinks that the housing market is going to be stronger, that there are signs of a turnaround that are emerging much earlier than maybe had initially anticipated. It is important to point out, though, like you said in this Evercore note, that they pointed to tentative signs of a recovery. They're not fully bought in that we're going to see a huge, tremendous turnaround right away. It's going to take some time. Also, keep into account that Zillow has performed pretty well year to date. It's up, 30-something percent?
More than 30%.
So, since January 1st,
Yeah.
obviously was under a tremendous amount of pressure last year. But that momentum, at least it points to Evercore's recent note, they think that momentum is going to continue.
Well, you would look at that chart right there and think, gosh, maybe all the positive has been taken out of it. But again, according to that note, they think there's still 40% upside. Where the stock is today, though, still, again, sorry to give you the ups and downs of it all, but still off 80% from its 2021 high. So there's a lot of different elements to this housing market. We're going to get a much better picture this week. We're going to get NAHB data. We're going to get building permits and housing starts. That's Wednesday into Thursday, I think. So the picture in terms of housing will be much clearer Thursday afternoon.
Yeah, Evercore's
And
new
we'll have
price target
rates as well.
Yeah, rates, and then Evercore's price target 61. So even though we have seen that momentum, they see it headed much higher than where we are today. All right, let's take a look at gambling stocks because those finished today in positive territory after last night's Super Bowl. Josh Schaefer has been tracking the latest in that space. And Josh, we were expecting big numbers. What are we seeing? Yeah,
so big numbers. They really did come to what we were looking for here. And so we don't have all the numbers yet. It's still a little early as far as how much did these companies make, how much was fully bet from a dollar amount. But what we do have that we can look at is geo-comply data. So you've heard a couple people talking about this today. And what that is it is the platform that checks your location when you sign into a sports book. So it is not how many bets, but it is when you check in and make sure you're in a legal area. And so they recorded over 100 million geolocation checks on Saturday and Sunday. Wow. To put it in perspective, that's up 25% year over year. So 25% more people checking in. And what you're seeing here now, this is State Farm Stadium specifically. So they have this cool little video you can see where you can see people checking in, and you obviously see it gets bigger as it gets closer to game time. That video starts at about 10 a.m. on Sunday. And went through the end of the game. They saw over 100,000 check-ins at the stadium yesterday. So we had talked about that on Friday, guys, how many people are going to be live betting during this game. And it seems like there was quite a few people, Dave, that got excited like I did when Patrick Mahomes got hurt and might have hopped on that,
Nice play there. Is there any way to track who might have been the winner of these platforms, DraftKings or FanDuel or MGM and so forth?
So we can certainly know that later this week. New York, for example, will have their numbers out on Friday. We'll know concretely who literally made the most money. Right now, I know FanDuel is telling me that at one point last night, 50,000 bets per minute was their peak.
Per minute?
Fielding 50,000 bets per minute. And from my knowledge, I didn't hear of any outages either, which I think is perhaps the most impressive part of that number, right?
You're right.
When you really think about
I was on the apps
fielding,
a lot of the night. And
fielding 50,000, I was sort of just checking them to see if they were all working, and they were, and then just to see if they were working.
50,000 a minute?
Just to see if they were working. 50,000 bets per minute was the peak. And then FanDuel also saying that they had more than 2 million active players bet throughout the game. So pretty eye-popping numbers there as far as how many people were on the apps. We'll find out again later this week exactly what the numbers were on how much those people were betting and how much they won.
A BetMGM spokesman called it the most successful Super Bowl and the most bet-on single-game sporting event ever. For some context, while on the subject of sports gambling, the most hyped-up ad campaign leading into Super Bowl 57 was FanDuel's Kick of Destiny, starring legendary Patriots tight end Rob Gronkowski, but did it live up to the buzz, to all this hype? You be the judge.
Rob Gronkowski kicking for $10 million. His trainer, Adam Vinatieri, with the Gronkowski family looking on. Here we go. The kick is up. It's no good. He missed it.
So that was a shank. And I'm not talking about the kick. I'm talking about the ad. My wife turned to me and she said, "Is that the ad you were excited to see?" It was supposed to be live. It certainly didn't feel like it. There was no buildup. It really did not deliver. Or am I wrong, guys?
No, you are spot on, at least from my perspective. What do you think?
I think the hardest part about that ad, like you said, Dave, as far as the live aspect goes, is it when you go to a remote location like this, it just doesn't quite look live, whether it is or isn't. You need to be on the field if you're going to do a live ad, because you're trying to get your attention. We all sort of popped our heads up and we were like, oh, it's the FanDuel ad. Oh, okay. Now, I do think from a business perspective, I think you can still argue they win in the sense of they're giving everyone the money still. They still gave out $17 million worth of free play. I think customers are happy. So maybe you didn't get new people excited. Your wife wasn't overly excited about the ad. But I think there are plenty of people sitting with some credit on FanDuel that are excited to go and use it, and that's sort of the point of the ad.
Yeah, of course, and that could be the win, and that will probably be the angle that FanDuel goes with. But even just the angle that we were looking at for the kick, I couldn't even tell, and I watched it back, 10 times this morning? I still wasn't sold until you freezed that exact frame that I could see that it actually kicked. From my perspective, I actually thought he made it. It just shows how they missed the mark. They could have had another angle there with the camera. Lots of hype going into it. I don't know.
It was a great plan.
It was. It certainly drummed up a lot of the hype ahead of the game.
Yes, but did it deliver? It just went wide left.
Well, maybe Gronk needs to be a better kicker.
I
Definitely could have better angle. I agree on better angle.
I don't think the make would have changed it. It was the feel, the build-up. I need a reporter live.
Even see it.
I need Kay Adams there on the field broadcasting. But anyway, we won't.
Dave will produce it next year.
Next year, give me a call, okay, FanDuel? Thank you.
Oh my goodness! All right,
Josh Amy Howe, give me a call.
All right. Well, speaking of the Super Bowl ads coming up, the Farmer's Dog Super Bowl ad tugged at the heartstrings of many. The company's CEO tells us why they decided to make the big ad buy at the big game. Next. I'm gonna love you forever.
Hey there.
That was the heartwarming Super Bowl ad for pet food company The Farmer's Dog. The ad won USA Today's Ad Meter competition. Not bad for its Super Bowl debut. Joining us now is Jonathan Regev, the Farmer's Dog co-founder and CEO. Good to see you, man. Would you have ever anticipated this type of reaction from the audience?
Absolutely not, no. And to be frank with you, I mean, it's quite overwhelming. I think this was a very vulnerable ad for us. We spoke very little about the product and really just wanted to communicate, who we are, why we're doing this. And I can't tell you how many tears we've shed editing the video, but even more so seeing the reaction from people, the love they have for their dogs, and the way it's resonating with people, understanding what we're doing and why we're doing it.
Yeah, Jonathan, I shed a tear watching it. Clearly, it was a massive, massive hit for you guys. Can you give us any insight just on what this has done for traffic on your site today?
Traffic is up.
I would expect pretty big.
Traffic is definitely up, and I'd say, the team, given this campaign was not intended to be a Super Bowl spot. We really made that decision after we saw it, and it was just something that spoke to us, and we said, people need to see this. So we've really only prepared the site for the last month. That type of the team's just done a job, and we don't believe the site went down. Although if anyone did experience that, reach out to us. But we're pretty sure it held up very nicely.
John, you would definitely know about that if that were the case. My co-host here, not even a dog person, and it made her shed
you're outing me.
a tear. Do you know how much? Can you quantify the Super Bowl boost you got?
By the way, that just means you're not yet a dog person.
Yes.
I think you have it.
There we go.
Yeah,
I agree with that.
We can work on that.
Can you quantify that boost, though?
We aren't really disclosing any specific numbers, but I mean, it's certainly considerable. Like, we were very happy with again, the interest that was generated. But I think the most important thing that we were looking at was just how it was resonating. And again, that's just been overwhelming.
The reporting was that a 30-second ad cost $7 million, which leads one to believe yours was $14 million. Is there any truth to that? And how do you come to the decision to make that kind of spend?
I don't think we're allowed to comment on the specific spend. But as a company that is mainly direct to consumer, strictly direct to consumer, and we do that because it allows for a product that is completely different and unique than what you'd find in a retail store. But being direct to consumer, one of the jobs we have is to find our customers, find the people that need us and that want us. And so advertising is an important component of that. But also, even more importantly, we're up against decades and billions of dollars of advertising, basically convincing people that the healthiest thing you could feed your dog is this ultra processed pellet. Our mission is to change that. It's why we started the company. It's really for what the ad speaks to, which is the healthiest life and the most time we can enjoy with our dogs. So advertising is just an important component. We felt this was a perfect spot to help connect with our people, with dog people, and hopefully they get what we do and why we do it. And so, I mean, it was a bit of a risk, but a risk worth taking. I think that the faster we can get our name out there, the faster we can shift people over to what we believe is a much healthier diet.
Jonathan, just walk us through just in terms of how you came up with this magic formula. I know you were saying that you didn't initially shoot this for this commercial to air in the Super Bowl. It did. You guys hit it out of the park. It clearly resonated with millions of Americans. How are you able to convey this emotion so well? And what have you learned also from this experience?
We were concerned. I think the idea was really simple, and it made sense, but simple is hard to do. And I think emotional content is also hard to do. So we were concerned that we had to be able to do this well. The spot was generated completely internally. We have an amazing brand and creative team. And then we found a fantastic director and production team that really helped us bring it to life better than we could have imagined. I think the thing that we really learned and part of the surprise around the ad doing so well and resonating so much is that I think we didn't really follow the mold of a typical Super Bowl ad. And we really just felt we wanted to be authentic. Like, what's the most authentic story for us? And let's just develop that. And then once we saw it, we're like, okay, this needs to go in the Super Bowl.
That's terrific. So I am a dog lover. My dog is my best friend. What does separate your product from all the others out there?
Well, so typically when you're in a pet food store, the two components that really differentiate us, besides the experience and the convenience side, I just want to focus on the food for a second. But the two big things are, one is the incredible amount of processing that pet food goes through to be shelf stable, sit in a paper bag on a shelf for months on end, even years. And there's a reason they all look the same, smell the same. They're these little brown pellets, and they're in bags that have these fresh ingredients on them. But they often don't use any of those fresh ingredients. They'll say, we use chicken meal, and you think that's a nice, beautiful chicken breast because that's on the bag, but it's really they're using a powder that was rendered from chicken that was going to go to waste or is not able to be fed to a human. And so there's the processing aspect, which we believe can really be problematic. And so we keep everything fresh. And because we ship direct, we're able to do that. But the other component, which is maybe even more important, is that the facilities that we use to make this food is human grade and or are human grade. And that only means that they are under a stricter regulation around safety requirements. And nothing in our facilities are allowed in that aren't something that would be edible for a human. And it doesn't mean it's tasty. There are a lot of ingredients and cuts that Americans don't like, but it's safe. And so we basically are strictly made in a human grade environment so that we can make something fresh and keep it safe. And so those are the really two big differentiators. And I think the thing that drives us all the time and the thing that had us just literally just weeping after the spot were all the comments and reactions from customers that have tried our food. So it's something that drives us every day, that the actual difference in food.
Love the emotion, man. Jonathan Regev, Farmer's Dog, co-founder and CEO. Congratulations, sir.
Really appreciate it. Thank you.
All right, coming up, there is new hope for early-stage Alzheimer's patients. Find out how one drug that just hit the market can slow down cognitive decline when we come back. There is new hope for the more than 6.5 million Americans suffering with Alzheimer's disease. Japanese pharmaceutical company Eisai, along with partner Biogen, has a new drug on the market called Leqembi, which could help in the treatment of early Alzheimer's. Joining us now is Ivan Chung, Eisai chairman and CEO, and with us for the conversation, Yahoo Finance senior health reporter Anjali Kamlani. Nice to see you both. Ivan, let's start with you, sir. How does your drug differ from those the rest out there on the market?
Yeah, so as you know, we recently received the accelerated approval from the US FDA on Leqembi, and on the same day, we also filed for full traditional approval to the FDA for Leqembi based on the late-stage phase 3 data called Clarity AD. So the biggest uniqueness for Leqembi, I would say, is Leqembi being the first therapy to truly have convincing late-stage phase 3 data showing that this drug meaningfully and statistically slowed down the progression of this disease over at least 18 months.
Ivan, looking at what you're facing now, obviously it's out there, you've gotten your first prescriptions in, but talk to me about the broader market, because we know that CMS still has yet to make a decision, and that's sort of the biggest obstacle for you now, is it not?
Right, and as you know, Anjali, we talked before, the CMS in this national coverage decision policy issued last year made it very clear that a therapy needs to have the full traditional approval from the FDA for the CMS to consider broader access. And that's exactly why on January 6th, on the same day when we received the accelerated approval, we put in the supplemental BLA on the same day for full traditional approval, because on that day, actually, CMS Administrator Shakita put out a statement saying that on the same day of Leqembi receiving a full traditional approval, a broader access will be provided. We find that very encouraging, and we have been working very closely with the CMS, including a recent meeting after the Leqembi accelerated approval to chart the path forward.
Well, I'm glad you brought that up, because I know that, we cannot forget that you are still sort of in the shadow of Aduhelm and the pushback that was felt then. So how confident are you that you're going to really be able to push through with this, and that the demand is going to be there by comparison to what we saw with Aduhelm?
Yeah, first and foremost, I think it's not about what I say or what Eisai say. It's really about what the community what the Alzheimer's community is talking about Leqembi. A couple of things. I think that was back in December. The Alzheimer's Association, the largest patient advocacy group in this country, sent a formal request to the CMS to request for reconsideration of the policy. And interestingly, attached to that formal request is a letter undersigned by 220 Alzheimer's disease scientists and clinicians talking about a new era for Alzheimer's, beginning with Leqembi. And also just a week or two ago, the American Academy of Neurology, which represents over 38,000 neurologists, also put out a letter calling for the CMS to provide expedited broad access to Leqembi upon full traditional approval by the FDA. I think this is what the stakeholders are talking about Leqembi, which I believe is the most relevant voices out there.
So we talked a little bit about Aduhelm, which has a cost of $56,000 a year. Your drug is now at $26,000, Leqembi. This is such an emotional and painful journey families are going through. Can you talk a bit about what makes these drugs so expensive and how these numbers might be able to come down in the years ahead?
Yeah, so we believe in full transparency in how we come to the pricing number. We put out a public document out there that we showed even all the mathematics behind what we believe to be the societal value of Leqembi, which our estimate per patient per year at the range of over $37,000. We are pricing this drug at just above 26, as you said, and we are working very hard on a maintenance dosing regimen of less frequent dosing, which means after 18 or so months, when patients go into the maintenance dosing of less frequent dosing, that number of more than 26 could be cut in half. And we believe we're giving back more than half of the societal value of Leqembi to the American public, and this is Eisai's commitment. Last point I would make is upon the CMS broader access for Leqembi, if you look at the out-of-pocket cost for the patients, the different Medicare channels, you look at the under 65 commercial channels and other channels, the weighted average per day out-of-pocket cost could be just around a couple dollars. So we believe, we take patient affordability and health system sustainability into full consideration in this pricing decision.
Okay, Ivan Chung from Eisai, Anjali Kimlani, thank you both. Very important conversation. Appreciate that. Ford is teaming up with the Chinese company to build a new battery plant in the United States. We'll have the details when we come back.
Ford is expanding its footprint in Michigan, announcing plans for a new $3.5 billion battery plant for EVs, and they're doing it with a Chinese supplier, despite some of the rising tensions that we've seen between the U.S. and China. Senior autos reporter Pras Subramanian joining us now with more on that story. And Pras, I know you spoke to one of the executives at Ford. What did you learn about this announcement?
Yeah, Ford going big here with that $3.5 billion plant in Michigan. They're making these LFP batteries, which are a little bit different than normal kind of nickel batteries that we normally see in EVs. They're cheaper to make. They're more easier to make. They also can charge more and kind of discharge more without kind of degrading. But they're not good for like high power usage like towing and things like that. But good for commuter cars. It's a good thing for like their Ford Mach-E's and cars like that. Ford says this investment is part of like their $18 billion that they put in the U.S. just for batteries alone. But yes, you brought up the CATL element there. This deal actually, Governor Youngkin in Virginia canceled this deal because he was concerned about the China element, saying it was a Trojan horse for China. So, we spoke to Lisa Drake, the VP of EV industrialization at Ford, about this, and I asked her did she have any concerns about China given what's been going on recently?
No, it's not. The auto industry in general is a huge global marketplace. We try and distance ourselves as much as possible from any geopolitical tensions, and we really focus on what's right for our business and for our customers. CATL is the largest battery supplier in the world, and they have great LFP technology, and it's in many of the devices we all use today in the U.S., and it's even in some EVs today, but it's all imported into the United States. And we took this opportunity to actually put our investment in the U.S. with American manufacturing jobs so we can make the technology here in the U.S. As we mentioned, 2,500 great high-skilled jobs, all of the indirect jobs that will come with that as well, right here in the state of Michigan.
So yeah, Ford says that the plant is owned by Ford wholly. All the employees are Ford workers, right? And they're just licensing the tech from CATL. There's no CATL sort of operation there, aside from this technology licensing.
It's just tenuous timing. Not great timing given all that's going on in the world, all the geopolitics, the spy balloons, whatnot. Not a great look to be announcing that of all days today. The requirements in the Inflation Reduction Act, how did that play in here?
So I asked her about that as well. Did the IRA have any effect on them? I said, yes, absolutely. This is one of the big reasons why they wanted to have this plant in the U.S. to build these batteries here, because of the critical sort of requirements needed for the federal tax credit. You need to actually assemble the batteries in the U.S., let alone get materials for those batteries. So that's why this is a big part of it. But yeah, you're right, Dave. I mean, talk about like the timing just couldn't be better for them. I mean, just after the fourth balloon in the U.S. here.
Yeah,
so I think that's why it's a little bit on edge about that, but they're happy with the deal.
Yeah, I was surprised to hear Jim Farley earlier today say that there was no U.S. alternative that could have taken place of that Chinese company, which begs a lot of questions, which we don't have time to go into at the moment. Praz, good to see you. Thanks. Okay, Southwest Airlines executives testifying to Congress last week over a slew of canceled flights over the Christmas holidays, and we're being kind. It was an absolute meltdown. The airline has been in hot water since leaving millions of people stranded after a storm grounded planes across many airlines. Southwest was not able to recover as fast as the others. It took nearly a week, even a couple of weeks, to be back up and running. Yahoo Finance's Danny Romero here with more on the hearing and how Congress can help keep these executives accountable. I'm skeptical, to say the least.
I think a lot of people are as well. But like you said, last week, senators really made it clear that their frustration on behalf of their constituents in regards to this holiday meltdown. And we heard from Southwest's Chief Operating Officer, Andrew Watterson. He said that they are implementing steps to really ensure that this dysfunction doesn't happen again, this operational dysfunction. And so far, we know as of Friday, Southwest Airlines has rolled out their new scheduling. But the bigger issue at hand is winter resiliency. And that's going to take some time to really roll out. And so they are taking steps in regards to that. They said that they are planning to meet with airport officials from both Denver and Chicago in ways of infrastructure, like an infrastructure system when it comes to de-icing. They talked about de-icing trucks, a new system in regards to that. We'll see how that plays out, but they are willing to invest. They are expected, to invest about $1.3 billion in upgrading their technology. I did speak with a senior fellow from the Brookings Institute who did testify during this congressional hearing. And he said, Danny, I didn't get the gist of what really was the problem at hand. We didn't get to the heart of it. We heard aspects of where the problem could have been, but we didn't get to the anatomy, the systematic breakdown of where this dysfunction happened. And so I asked him if there would be any legislation changes, and he said, not likely. It really was, senators got the chance to point the finger at Southwest. And
they got their TV sound bites.
Exactly. And then from there, obviously Southwest is under a lot of heat. And so they're trying to implement this. But who knows? This could happen a couple months from now. It's really unclear. I mean, they're trying, obviously, to tackle the issue at hand. They're putting all these different systems in. Hopefully we can see it.
Their captain of their pilots union told us he was very critical of the computer system and their system that links pilots to planes, saying that both are a debacle. So we hope they make those changes. Thankfully, there's no massive weather events coming. Danny Romero, thank you. Okay, coming up, it's New York Fashion Week. Designer Sergio Hudson is here to tell us about how his show went and the latest trends. Next. New York Fashion Week kicking off this past weekend in the Big Apple. The runways are full of color and catwalks. Yahoo Finance's social media reporter Kelsey Barbario got the lay of the luxury land.
Kelsey Barbario here at the Sergio Hudson Show at New York Fashion Week. Luxury fashion may have taken a little bit of a break during COVID, but we're here to see if it might be back.
I, of course, still love to buy designer, but I am more mindful and I don't buy designer at retail.
Luxury fashion definitely took a break. I've definitely cut back on my shopping for sure.
Since the pandemic, I've made a few luxury purchases in between, but now, like with the pandemic, with inflation, I'm like, we kind of got more important things to worry about.
I've gotten a lot more into like thrifting and like going to consignment shops to find pieces.
Luxury fashion did not take a break. I feel like, if anything, it went even crazier. I feel like people are shopping more now than ever.
I think the recession plays a huge role in the economy, and unfortunately it hits the arts first.
Not a pair of sweatpants in sight here at the Sergio Hudson Show. This is the kind of place that shows you that luxury fashion, while it may have taken a small break during the pandemic, although people here may question you on that, I have to say it is very much so back.
Love that big old bow. There she is. Yahoo Finance's Kelsey Barbario is with us now. Kelsey, I've never been to Fashion Week. What are you seeing there?
So there is a lot going on here. As you can see, there are tons of people behind me, the craziest, coolest outfits you've probably ever seen. But there are a few big trends that are going on here at Fashion Week. The first one, pantslessness. There are people not wearing pants all over the runway. We can thank Kendall Jenner for that one. Aside from that, we've got people DIYing a lot of their outfits. We've got a lot more DIY going on, a lot more thrifting. I think people are being a little bit more financially conscious than perhaps they were a year or two ago. And outside of that, we've got a lot of inflatable puffy fashion. Back in the fall, Moschino showed some different inflatable designs, actual inner tubes on their clothing. And because of that, I think that, there's that designer and then there's a million others. We've got Carolina Herrera showing giant puffy tulle. I think that inflation is on everybody's mind and it's going to continue to be that way.
Saw a little bit of that from Rihanna last night during the Super Bowl. I know that was Bill. It looks very comfy though. Kelsey, we also know that social media they have a massive influence here in the fashion industry. From your perspective, how big is the influencer game at the shows this year?
That is the common theme. Influencers are all over New York Fashion Week. Some people are complaining, they think it should be a place that's meant for some of the editors and true fashion professionals, but others say, hey, influencers being out here, that's going to bring way more exposure than, maybe even a magazine in a certain sense these days. Outside, in terms of influencers, we've got people that are being paid probably tens of thousands of dollars to attend these shows. I saw that Alex Earl, who's very popular on TikTok, she was definitely at a show. And while it may be just like a gifted, fun thing, I would be willing to bet she made some serious money off of it.
We certainly are on a fun assignment this week. Kelsey Barbario, thanks so much. And of course, we also want to mention Yahoo is an official sponsor of New York Fashion Week this year. All right, well, since we are in the midst of New York Fashion Week, designers watching their creations hit the stage, hit the runway for all to see. Our next guest is one of those designers with a big show this past Saturday filled with lots of bright colors. Sergio Hudson, creative director of Sergio Hudson Collections, is with us now in studio. You brought the bright colors to us. We love it. Sergio, congratulations on your most recent show. Just set the scene for us just in terms of this year's Fashion Week and how it's compared to what you've seen in the past.
I think this year, with the looming recession, everyone was very conscious of that. And I think what we came to realize is I wanted to change the tone of what was happening. Like, okay, you're thinking so dark and gloomy. Let me give you something really bright to look at. And no, we always go through recessions, but we always come out of them. So I feel like I just wanted to give people some kind of joy as opposed to giving them what they're feeling.
Thank you. We like that. We need a little brightness. So how do you think, if at all, the COVID pandemic changed fashion? I know a lot of us just wanted to be comfortable in COVID, and a lot of the men at least have maintained that priority out of it. Have you noticed a shift in fashion?
I think it's very interesting. If you look at the first part of the pandemic, a lot of us designers had to make a shift. Like a lot of us started making masks and pajamas and, shifted into home, which I did in the beginning. And then there was the shift, like, okay, people were like, okay, I'm ready to put clothes back on again. And if you check, like the main stores, like a lot of them had their best years on records in 2020 and 2021. So it was like this shift, and like people ran back to fashion, and they really wanted to, spend a lot of that money that they had been saving in the beginning. So like people had the money and they're like, okay, I'm ready to shop again. And now we're looking at, probably the reverse of that. But I think it was very interesting, the ups and downs of luxury fashion during the pandemic. A lot of brands saw their, my brand really took off during the pandemic. But of course that was attributed to us dressing First Lady Michelle Obama during the inauguration. But that's when my business really became profitable after that.
That certainly does help. So you've dressed Michelle Obama. You've also dressed the likes of Beyonce as well. When you talk about dressing those types of big names, where do you draw the inspiration, but then also have it be a brand that so many people can relate to at the same time?
I think when I'm dressing those women, look, at the end of the day, they're real women that want to look beautiful, and that's who I cater to. And they are drawn to me because of the clothes that I put out there. So a lot of times when I dress these women, it's just something that I would normally design. Take the First Lady Michelle Obama's outfit, it was directly from my collection that I had shown the year previous. So, it's kind of just like if they're drawn to you, they'll wear your clothes because they're women at the end of the day. And I think that's what people have to remember. If a woman likes clothes, she's going to wear them, whoever they may be.
And to that point, how do you design for Michelle Obama and Beyonce and then have a line at Target? Obviously a very different demographic and perception.
Well, I mean, the thing about the Target collaboration, we worked very closely with them to come up with something because at the end of the day, I'm a luxury brand. I can't reach everyone. And there are people out there that will never be able to afford my clothing, but they've supported me from the very beginning. And they can shop at Target and they can afford their price point. So it's really a gift that Target gave me to be able to reach those people, because at the end of the day, when you're a luxury brand, it's a lot easier to reach those customers than it is to reach the masses, because it takes a lot more money to own a Target than to own a brand like mine.
And what was it like working with Target to create this line? And do you have plans to maybe expand that line in the future?
Well, it was amazing working with them because their access is so great and vast. Any idea that I brought to them and they came back at me with their ideas, it was just a great collaboration, but they could do anything. I was shocked at the quality of the work that they did and how fast they could get it out there. At this moment, it was just a collaboration. They do this every year. They pick certain designers. So I don't know. I'm open to it in the future, but as of right now, it was just a one-time thing.
Sergio, you recently won an award at the 15% Pledge Gala. What is the pledge? Why is it so important to you in your particular industry?
I think the 15% pledge is important because during the pandemic, the founder, Aurora James, she came up with this idea that, okay, we as Black people in America, we make up 15% of the population, but we take up, I think it was like less than 2% of the shelf space in the stores. We should at least have 15% of the shelf space. It was kind of like a duh moment.
Seemed common sense.
It's like, okay, that's cool. Yeah. Like, we take up this amount of population, but you would not believe the amount of kickback she got for just saying it and asking people to pledge to it. But she's done an amazing job of, getting it out there. And the award was, they have come up with this way to give grants to brands because we're self-funded. Like, I dress all of these people and people assume that, we have some big juggernaut behind us, but it's really us. So it's just a grant to help us keep going.
And Sergio, real quick before we let you go, we know the fashion industry obviously so competitive. If you could give one word of advice for those out there that are trying to break into the fashion industry or start their own line, what would you tell them?
Be true to yourself and believe in yourself, because if you don't, nobody else will, for sure.
Good tip. Sergio Hudson, appreciate you being here.
Thank you for
Thanks so
having
much. Want to mention Yahoo is an official sponsor of New York Fashion Week. Coming up, Barney the dinosaur getting a makeover, and he looks nothing like the character you grew up with. Stick around for the reveal.
Let's take a look at some of the movers that are trending after hours. We have Palantir, Avis Budget, and Denny's. Kicking off with Palantir, you're looking at the stock jumping just about 20% in extended trading. The company reporting its first profitable quarter here for the fourth quarter. They also said that they expect 2023 to be the first ever profitable year. That's a big reason why the stock is soaring here in extended trading. Q4 sales, $508.6 million. That beat the street's expectations. Revenue from its commercial clients was up about 11% in the fourth quarter. Government sales, that increased by 23% over the last 3 months. Still looking at losses of just about 9.5% over the last year. Still down about 42%. Flipping over to Avis Budget, that stock up nearly 5% in after-hours trading. The company's fourth quarter earnings beating the street's expectations. Demand for travel in the fourth quarter was strong, and the CEO of Avis saying that he expects that to continue here. Those trends have continued, he said, into the first quarter. You're looking at gains of the last year up just around 21% over the last 3 months. So the stock is just barely in negative territory, off just about 3.5%. Let's take a look at Denny's. That stock also moving to the upside here, up just about 2.5%. Adjusted EPS coming in at 18 cents. That beat the street's expectations. Revenue $120.8 million. That's growth of about 12% here for its most recent quarter. Domestic same-store restaurant sales were up 2% on a year-over-year basis, and the guidance there for same-store sales, they see 2023 comp restaurant sales there, the growth of up to 6%, so 3 to 6% growth. You're looking at gains of about 2.5% over the last 3 months. That stock is off about 4%, Dave.
Okay, Shauna, thank you. Guess who's back? Barney, your favorite purple dinosaur, will return in an animated series launching next year. In addition to new content, Mattel is turning out a new line of Barney toys, books, and accessories in 2025. Now, Barney was born way back in 1992, but has been off the air since 2010. Said Mattel Global Head of Consumer Products Josh Silverman, quote, Barney's message of love and kindness has stood the test of time, which is interesting, Shauna, because before that animated series comes out next year, Peacock will debut a docuseries in October entitled I Love You, You Hate Me. No joke. That's what the docuseries will be called because so many people hate Barney.
So many people hate Barney, or you either hate him or you love him. I loved him. I actually tried to I didn't even know about this news, and I tried to get my 3-year-old to watch Barney over the weekend. He's a little young for it, but it is educational. It does get the kids' attention. I think there are a lot of reasons to like it. Do I think he does get a bit annoying sometimes? Yes, but I don't think you can go as far and say that you hate Barney. It's just a purple dinosaur after all.
Can you sing the jingle?
How does it go again? Try.
I love you.
You love me. Yes, I do know.
I don't know the rest of it, but I know when I hear it, it makes me want to pull my hair out. So I think that docuseries title is perfect. Yeah. I do tend to hate him a little bit, but it's a good move by Mattel. I think there is probably a big audience out there, and maybe they'll tweak that jingle a little bit, right?
Yeah, they could tweak the jingle. They can make it. But I mean, you know what? It works for them. It's very catchy. Once you hear it, it's hard to get out of your head. I actually couldn't think of it, and then right when you started singing it, it brought me back years and years and years ago. So I think it makes a lot of sense for Mattel. We'll see what the numbers look like. We'll see what their product line looks like. I'm excited. You're not. You don't have kids, though, that are as young as mine, so that's why.
I love you. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell.